Hi all, and welcome to TCM's educational series. And in this video we want to discuss a semi-controversial topic. Do we want to trade as day traders according to points or percentages? Now I know that old-timers like me and most of the day traders never heard about this concept, trading intraday according to percentages. That's something that wasn't that viable in the past because the movement in individual stocks wasn't that aggressive. Over the last couple of years with algos and maybe now with AIs, things are gonna, I think, expand positively in terms of potential for day traders, and now we can talk, or some of us will talk about trading according to percentages versus points. Now, for those who don't understand what I mean, exactly mean is that if you remember in the past, an entry in a stock would be, let's short a stock at 25, take a 20-cent risk on the trade and look for 20 to 40 cents on the outcome of the trade. So what does it mean if we translate it to percentages? Basically it means let's short at 25, take almost a 1%, which is 25-cent risk, and look for 2% to the downside. That's how it really translates. Now, again, in the past we were used to taking each trader according to his preference a certain amount of shares. So if I'm taking short at 25 and I'm comfortable with shorting let's say 1,000 shares, the stop loss is 20 cents, my maximum loss assuming good liquidity is $200. So I'm talking about quantities and cents, not talking about money and target in terms of percentages. So now with ranges expanding in stocks that have incentive to move, like earnings, news, something aggressive is happening, the concept can expand into trading according to, let's say, okay, I'm going to short, instead of talking about 100 shares, I'm going to short $10,000 of a stock, okay? And the translation is immediate. I mean, if the stock is $100, that means 100 shares. If a stock is $10, that's 1,000 shares. Also now, as opposed to in the past, trading costs are significantly lower, at least for the traders in the US, which is most of the viewers here in this channel. So the concept of buying more and paying more commissions, again, I'm not really 100% who's trading what and where, and maybe some of the viewers of this video are trading in Europe and there the commissions are way higher, but whoever's trading the US markets and doesn't trade the US with a US broker, of course, I don't think he can afford not to trade with a US broker or an offshore broker. So let's see examples, okay? Because that's a bit complicated in theory. So you're watching the ASAN chart. Yesterday ASAN dropped 20% on earnings, okay? And I'm a trader now, an old timer, and looking for a trade. And let's say I want to short ASAN because the trend is clear, and you can see the downtrend here in ASAN basically all day, a big gap down in the morning session, and then lower highs all day, and actually it closes beautifully at the lows of the day. So anybody that shorted during the trading hours, ASAN, most likely, unless you shorted it, I don't know, I don't see a bad trade short here, especially if you look at those VWAP reversals, which are very crucial short entries on a weak stock. So let's take for example this reversal play here at the VWAP, let's call it 1580, or let's round things up, let's call it 16, and the move here goes from a couple of cents under 16 to let's say the close is at you know what, let's go with this $1 move, just to make this very, very simple. Okay, so I'm shorting 1,000 shares at 16 or 15.90. The stock goes down for 90 cents. I'm closing it luckily at 4 p.m. I made $900. Okay, I'm not going to discuss the risk, which is a super important part of day trading, but I'm not going to discuss it. Okay, now let's move to the other option of computing, and let's talk about now. I'm not talking about 1,000 shares. I'm talking about a money position. So let's say my account, I am a US trader. I have minimum 25 grand in my account. Let's say I have 30. I have $120,000 available to day trade. I'm going to short, obviously not my whole account. I'm going to short here $20,000, and the stock goes from down 6%. So $20,000, 6%, that's $1,200. Again, I'm not computing the risk. The idea here is that if you are a trader that doesn't have money or financial problems here with buying power, okay, you can trade both ways, either with shares or either with quantities, but you can expand, okay, into trading with quantities, because on one hand you don't have a limitation of your on your budget entering this trade. So if you have let's say an unlimited budget, or you have a big account and you can afford here to look at a trade at $40,000 position, and you risk maximum 1% or 0.5% according to your strategy, then you're looking at a huge winner here that can carry you the whole day. So that's basically on if you made almost 2 grand on this trade, that's a hefty payout on trading a $15 stock. That's not it's not like you took a lot of risk. And again, the concept needs to be built within you as a day trader, how you feel comfortable trading. Now, one of the aspects of day trading with percentages is when the stop loss is not that clear, and you give yourself a range of $1% risk on a trade. So you're trading a $100 stock. The stop loss is anywhere between 60 cents to 80 cents, maybe $1. So you take a worst case scenario. In this case, 1%. 1% on $100 is $1. So you enter a position with $20,000. And it doesn't matter now what is the price of the stock, 80, 90, 100. If the stop loss is up to $1, meaning no more than 1%, and so your risk is 1% of your whole position, meaning on $20,000 it will be $200. On $40,000, of course, 1%. Building on this type of trading can actually be way easier, again, only if you're dealing with the high risk, high reward type of trades, because risking 1% on a stock that's moving or potentially moving up only 1% is a big mistake. You don't want to start losing 0.5%, 1%, 2, 3, 4 times a day. It will be very hard to recover. So if you have to be very, very picky and know exactly where you're going to analyze the risk reward and be in the right stock. So that's one example. Now let's move to another example, also from yesterday, $3, DLTR. Now, as opposed to ASAN, which had a clear downtrend, it's very tough or way tougher to trade the DLTR. So it was down in the morning, then up, then down again, and then closed up again, and then down again. So it had 1, 2, 3, 4, almost 5 major trend changes intraday. That's a lot of intraday changes to deal with. Having said that, let's look for 2 potential trades. You know what? I look for only one, which to me seems a bit easier than the rest. Take a look at this tested round number $90 reversal short. And this trade went exactly, I mean, this is almost perfect to the target, which was the VWAP. In this case, risking almost $1.50. Now the risk here was about 50 cents. So that was a 3-to-1 risk reward. Of course, in this case, you risk 0.5%. Let's round things up. So $90, let's call it 100. Stop loss of 50 cents is 0.5%. So what do you do in this case? Of course, you can trade a number of shares. Keep in mind that when you enter with a number of shares, you need to take into account, obviously, the spreads as well. Now, when you trade with a money position, you can ignore that and incorporate everything into the stop loss. So you shorted the round number, you place a stop loss of, let's say, for the sake of an easy computation. So you short $10,000, the risk is 0.5%. In this case, how much is it? $10,000. 0.5% is 50. Okay, only $50. So let's go with that. Okay, so you short here $10,000, you risk $50, and your maximum payout will be $150. Of course, you cannot take $150. Maybe you can take $1 out of the 150. So you go $100 profit versus risking 50 cents. Again, this is a trade where it really breaks the round number 90 clearly or cleanly and goes down, and then it reverses all the way up and then it goes down again. So a bit complicated. Again, the idea here is to open yourself to the concept of trading positions in terms of money quantities, and not necessarily being focused only on the concept. I'm trading 300 shares. It doesn't matter how big the price of the share price is. Of course, the stop loss and meaning the risk always is a big factor. And of course, there are many opinions. That's obviously, if I'll ask 10 traders, I will get 11 opinions how to trade, when to trade, and that's fine. Just making a point here, if anybody is into basically reacting to this video, I would like you to share it with your friends, and please post your comments, and we'll see you. Thanks again for participating, and we'll see you in our next video.